Hello, this is Will Allen with Centera Capital, and if this looks like a different backdrop to what we normally do with these market update videos, it's because it is. I was on vacation for 2.5 weeks in Italy and Switzerland in July. I've got back. We recorded a market update video on Tuesday. We're going to release it this morning, but there was a breaking news jobs report that came out and have moved the market. So we said we've got to do a new video where we go over some of the same information that I talked about Tuesday that is still very important, but also this new update that we got on the jobs report. So we're going to talk a little bit about this. We've got my computer behind me here. We're going to, Evan is going to zoom in on some of the charts as we're talking through this. And so the first thing we want to talk about is the jobs report today came out. 114,000 jobs were created in July. Expectations were around 180,000. Last year, the average was between 230 and 250,000 jobs created. So 114,000, much lower than what had been expected. We'll look over here at the unemployment rate. This went up from 4.1% last month to 4.3, and you can see that ever since we were last year in the, I think that was April of 2023, 3.4% was the lowest unemployment rate. You can see it has slowly been going up, and then the jump from 4.1 to 4.3% this month took the markets by surprise. So here's an important thing to mention. That 4.3% is much higher than the 3.4 that we had about 1.5 years ago. But 4.3% is still a low level. In fact, in the 1990s, which was a very good decade for economic growth and for the stock market here, the unemployment rate was lower than 4.3% for only 6 months in that 10-year period. So that's just something we wanted to mention. Now, what is important is the direction here, and if this rate continues to go higher in the months to come, that will start to be a little more problematic. Now, another chart that we want to show, because you can't look at just any 1 month of a jobs report because the data does jump around. It has a high variance. And so we don't want to look at only that. So we're going to put up a chart here of the initial claims for unemployment insurance. So again, we've talked about this a lot over the last couple of years. When people are laid off, if they can't immediately find another job, they go file for unemployment insurance. So let's turn back around here, and we're going to put this chart up. You've seen this chart if you've watched some of our videos, and what I say here, initial claims are at the upper end of the range since 2022. So after COVID hit, millions of people lost their jobs, filed for unemployment insurance. That started to come down as we went through 2021. And you will see 2022, 23, and the first 7 months of this year, claims have stayed in a range of around 190,000 to 265,000 were their peak last summer. And you'll notice that last summer, claims were around this 250, 260,000 range for about 4 or 5 months, okay? That's what's happened over the last 3 or 4 months. This has been slowly creeping higher. This week came in at 249,000. So again, we'll see if this continues to go up and breaks out the upside of this range, then that's going to be more problematic for the economy, because we've talked about this fact for the last couple of years. A lot of economists thought there was going to be a recession when the Fed started hiking interest rates. That has not happened, and up until this point, and one of the big reasons for it has been that the jobs market has been so strong. Again, if unemployment claims break out to the upside, then you're going to have more layoffs. That's what that means. And when people are laid off, they spend a lot less. So we're going to be watching that data much closer. Now, another chart that we want to bring up for you here is the Fed funds rate. And we talked about the fact that the Fed, again, had interest rates near zero. Once COVID hit, they moved rates to near zero. This then went up to 5.5%. Last July was their last rate increase. in December of last year is when the Fed told us, hey, we are finished with our rate hike cycle. In January, the market was pricing in that the Fed would cut interest rates 7 times in 2024. That seemed a little extreme, and we said we didn't see that happening. Then what happened over the following 3 months is the market took that pricing down to where they were pricing in just 3 rate cuts. And that, by the way, is where the Fed has been for the last 6 months. They've said, hey, we're projecting 3 rate cuts. Now, if you turn back and look at the chart, I'm going to take a sip of water here. You'll notice I have a star here, and it says 4.25%. As of this morning, the market has gone from saying by the end of this year that the Fed would cut rates. Previously, coming into this morning, it was at 4.75%, so pricing in 3 rate cuts. They are now pricing in the equivalent of 5 interest rate cuts between now and December. And they're pricing in September, the Fed cutting by 0.5%, whereas they typically cut by quarter-point increments or raise by quarter-point increments. So they're going to start off with a bang, is what the market is saying today. Now, this can change drastically. And we're going to be looking at the next jobs report, as well as initial claims for unemployment insurance each week, but the next jobs report to see, because there are a couple very influential analysts who've come out today and said that 114,000 jobs is an anomaly, and that will jump, they believe, back up over 200,000 next month. Now, we will see if that comes to fruition, but for example, if it does, then it's very unlikely that the Fed will cut by 0.5% at their next meeting, and it may be the case that they cut rates by the end of the year to 4.75, not to 4.25. But we're going to be watching this and monitoring your portfolios as a result. Now, let's turn back here to the charts, and the next one I want to talk about, and this is something that we talked about in the video that we did, the most recent inflation data, and this is month over month, the inflation rate. And you can see back in 2021 and 2022, this was soaring and you were having very high inflation. Again, 0 here, this line, that means there's no inflation. Prices have not moved, okay? So you can see this was up at high levels for a long time. But what I want to point out is in the last couple months, in fact, we had this past month, prices declined month over month for the first time since COVID hit. And so that's month over month. If we look year over year, you will notice that we've shown this chart multiple times. This is measuring 3 different inflation indicators: the consumer price index, the CPI, the Fed's favorite measure of inflation, the PCE, and then the measure of wholesale inflation, businesses, PPI. And what you'll see here, after all 3 spiked significantly and started to come down, this last month, year over year, prices grew at 2.97% for the CPI, the business inflation 2.63%, and then the Fed's favorite measure of inflation 2.5%. So come back. All 3 measures are now in the 2s. First time it's been that way since inflation started to spike 4 years ago. Now, as a side, it's very important to remind you that inflation, and because it went so high for so long, prices are much higher than they were 4 or 5 years ago, and consumers are not happy because of that. That shows up in every poll, every sentiment indicator. That's an issue. Setting that aside, why it's important that rates are in the 2s now year over year is that gives the Fed freedom to start to cut interest rates, because they could say, look, we have our Fed funds rate up at 5.5%, which was necessary when inflation was at 7-8%, and month over month we were seeing significant increases in prices. But now that we've had a couple months where prices have been flat or lower, and now that all the indicators are in the 2s, the Fed can say, look, we don't need Fed funds to be up at 5.5%. That's too restrictive. So that's the inflation data we wanted to talk about. Let's turn around here again, and I want to put up here the Bloomberg Commodity Index. And what you'll notice here is that commodity prices, and over here I have a breakdown of what makes this up. It's 30% energy, so oil and gasoline, natural gas, etc. 23% grains, 15% industrial metals, 19% precious metals, gold, silver, etc., and then 13% other, like you got sugar in there and coffee and whatnot. Notice that prices on this are basically at the lowest level they've been at since 2021. So commodity prices have come down. That is good news for future inflation trends. Now, the one last thing I'll show on here is pre-COVID, this was at 81. It's at 95 today. So you'll see what I say here. Commodity prices are near their lowest levels since late 2021. This is good, the trend, but they're still much higher than they were pre-COVID. So why we watch commodity prices is that this a lot of times tells you where inflation is headed, or at least one key indicator of it, because commodity prices impact pretty much all businesses and consumers. And so if this can continue to come down, this is going to, again, help the Fed and help future inflation numbers hopefully be lower. All right, let's turn back around here because we have two more charts here. One is while I was gone, the GDP report came out, and this is measuring economic growth in the United States. It came in at 2.8% versus expectations of 2.1. Now, what you'll notice is in the first quarter, this came in at 1.4. And a lot of economists were saying, hey, this is really bad news. You're going to see these numbers continue to decline. This jumped. In fact, the growth rate doubled last quarter and is back kind of in the range it was in 2022 and a lot of 2023, this August of last year being the exception here. But turn around here. So listen, this is backward looking. This was the second quarter. Right now, the Atlanta Fed's GDP Now report is expecting growth of around 2.3, 2.4% for the third quarter. Still a long way to go and a lot of inputs. But this is important because, again, this is telling you that, hey, for the last quarter, the economy was still growing at much stronger than kind of the baseline neutral level, which is more around 2%. Anything north of 2%, very strong number. All right. The last chart I want to show you here, or number here, and what we're looking at, this is something that we put up last year at this time. Notice that once you get into August and September, the last 5 years, the stock market has had a sell-off somewhere in this time frame, and that's what drawdown means, somewhere in this time frame of between 4.5% to, in 2022, horrible year, was down 16.8%. But you can see, take that out. The other years, 4.5, down 9.8, 5.3, and last year was down 7%. So we are entering August and September, historically the most volatile months of the year, and a lot of times you'll have a sell-off somewhere in that range, not all the time. And again, if you go back 100 years, on average, each month is down about 0.5%. But it's important to note that it's not unusual. We've seen in the first 2 days of August, volatility really spike, the market go down. That's not unusual. This, a lot of times, is a tougher stretch, even though you can get some nice gains somewhere in the middle of this period. Now, I want to turn around for the last time, pull the camera in. Take a look at, following these sell-offs, what has happened from October 1 to December 31st, and you can see the market has done extremely well, up on average almost 10% in the fourth quarter these last 5 years. Now, if you go back, the stock market in the fourth quarter has been up 10 of the last 11 years. So the fourth quarter is the best stretch historically for the market, especially once you get into November, December. This is an election year, and typically once the election happens, the markets have a very, very strong rally. Now, we're going to talk more about that in the months to come. But for now, what you need to know is we are closely watching portfolios. The stock market is in the middle of a sell-off that is the fourth decline since March of last year of between 6 and 10% for the market. We're now down. The stock market is down. The S&P is down 6%. The NASDAQ tech heavy down 11%. This is not unusual. We've seen this now 4 times in the last year and a half, and yet the stock market has recovered with strong gains following the last 3 declines. And what we look to do is buy on dips like that. When there's more panic in the streets, we get more interested. So we're watching your portfolios. We're monitoring things carefully. We'll have another market update here in the next week or two. Take care.